Olivia, I've been looking at the numbers again. Buying a car in 2026 might be one of the worst financial decisions someone could make right now.
I was thinking the same thing. The dealerships are still playing games with pricing, and most buyers don't realize how much they're actually losing the moment they sign.
It's not just the sticker price either. When you factor in interest rates, insurance costs, depreciation, and fuel, the real cost of ownership is staggering.
And most people go in emotionally. They see a car they love, and suddenly the monthly payment becomes the only number they're focused on. That's how they get trapped.
So before we break all of this down, we want to hear from you. Have you recently bought a car, or are you holding off because of today's market? Tell us below.
And if these kinds of honest, data-driven financial conversations are what you've been looking for, consider subscribing. We break down real decisions without the hype or the sales pitch.
Let's start with interest rates, because this is where most buyers are getting hurt without realizing it. Auto loan rates in 2026 are significantly higher than people expected them to be.
The average new car loan rate is hovering around 7 to 9% depending on your credit profile. That's not a small number when you're financing $30,000 or $40,000.
On a $40,000 loan at 8% over 60 months, you're paying roughly $9,000 in interest alone. That's money that buys nothing except the right to borrow.
And most buyers don't negotiate the rate. They accept whatever the dealership's finance office offers, which is almost never the best rate available to them. That's an expensive mistake.
The smarter move is to get pre-approved from your bank or credit union before walking onto any lot. That one step alone can save thousands over the life of the loan.
It also changes the psychology of the negotiation. When you already have financing secured, the dealership loses a major piece of their leverage. You become a much harder customer to manipulate.
Now let's talk about depreciation, because this is the financial reality that most car commercials never mention. A new vehicle loses roughly 15 to 20% of its value in year one.
That means if you buy a $45,000 car today, it could be worth $36,000 in 12 months. You haven't even paid off much principal yet at that point. Over 5 years, many vehicles lose between 40 and 60% of their original value. That's not an investment. That's a depreciating liability with monthly payments attached to it.
Which is exactly why the question shouldn't just be whether you can afford the monthly payment. The real question is whether you can afford the total cost of that financial decision.
This is a distinction that wealthy people understand intuitively. They don't measure affordability by monthly cash flow. They measure it by total wealth impact over time. That framing changes everything.
And when you frame it that way, a brand new car almost never makes pure financial sense. There are situations where it can be justified, but it requires honest and disciplined analysis.
One alternative worth considering seriously is a certified pre-owned vehicle that is 2 to 3 years old. You let the first owner absorb the sharpest depreciation curve on your behalf. You still get a reliable vehicle, often with remaining manufacturer warranty coverage, but at a price point that reflects the actual used market rather than inflated new car demand.
In 2026, used car inventory has improved compared to the supply chain shortages of earlier years, which means buyers now have more negotiating power than they've had in quite some time.
But you still need to do your homework. Always get an independent inspection before purchasing any used vehicle. A $300 inspection can prevent a $3,000 mechanical surprise later.
Insurance is another cost that buyers consistently underestimate when calculating what a vehicle will actually cost them. New vehicles, especially higher trim levels, carry significantly higher premiums than older models do.
And if you're financing the vehicle, the lender will require comprehensive and collision coverage, which adds another layer of mandatory cost you don't control once you've signed the purchase agreement.
The combination of a high loan payment, elevated insurance premiums, fuel, maintenance, and registration fees can easily push total monthly transportation costs past $700 or $800 for many households.
$700 to $800 a month is a significant portion of most household budgets. That money, redirected into investments, could be building long-term wealth instead of funding a depreciating asset.
Let's put that into perspective. If you invested $600 a month into a diversified index fund, earning an average of 8% annually, you'd have nearly $44,000 in 5 years.
That comparison isn't meant to make you feel guilty about owning a car. Transportation is a real need, but it should make you think carefully about how much car you actually need.
There's a psychological trap that affects buyers at every income level. It's called lifestyle inflation, and the car market is one of the most effective environments for triggering it unconsciously.
You go in planning to spend $25,000, and somehow you leave having agreed to $38,000. The upsells, the trim upgrades, the extended warranties, it escalates faster than people expect.
Dealers are trained professionals at moving buyers up the pricing ladder. That's not cynicism, that's just the business model. Knowing that going in is your first line of financial defense.
Setting a firm budget before you walk in and committing to it regardless of what the salesperson presents is one of the most important financial disciplines you can practice in that environment.
Another factor reshaping the 2026 car market is the ongoing transition toward electric vehicles. Federal incentives have shifted, and the resale market for certain EV models remains unpredictable and difficult to assess.
If you're considering an electric vehicle, research the total cost carefully. Battery replacement costs, charging infrastructure at your location, and insurance premiums for EVs can vary dramatically depending on the model you choose.
Some EV buyers have found genuine long-term savings, particularly those who drive high mileage and have reliable home charging. But it requires honest analysis, not enthusiasm driven by marketing or trend pressure.
The financial decision around any vehicle, electric or traditional, should be driven by data and your specific lifestyle needs, not by what your neighbor bought or what looks impressive in the driveway.
There is also a timing dimension worth considering. If your current vehicle is functional and paid off, keeping it for another 12 to 18 months could be the most powerful financial move available to you.
A paid-off car, even an older one with some maintenance costs, is almost always cheaper to operate than a new loan at current interest rates. That math is rarely close.
Maintenance on an older vehicle might cost you $1,500 a year in worst-case scenarios. A new car loan can cost you $6,000 to $9,000 annually in interest alone.
The emotional resistance to driving an older car is real, and we understand it. But separating financial decisions from ego-driven decisions is one of the core disciplines of long-term wealth building.
If you do decide that a new car is genuinely the right move for your situation, timing your purchase matters. End of month, end of quarter, and end of year tend to produce better pricing.
Dealers have sales targets and quota pressures. Understanding their incentive structure gives you leverage that most buyers never think to use. Patience in negotiation is consistently undervalued as a financial skill.
Always negotiate the out-the-door price, not the monthly payment. Dealers prefer to negotiate monthly payments because it obscures the total cost and creates room to extend loan terms invisibly.
A 72 or 84-month auto loan is rarely in your financial interest, regardless of how manageable it feels.
The full picture here is that buying a car in 2026 requires more financial discipline and more preparation than it did 5 years ago. The environment has become genuinely more expensive and more complex.
That doesn't mean avoid it entirely. It means approach it with the same rigor and intentionality you would apply to any significant financial decision, because that's exactly what it is.
Know your total budget. Secure your own financing. Research depreciation curves on the specific model you want. Get independent inspections on used vehicles. Understand your true total cost of ownership before you commit.
And always ask yourself whether this decision moves you closer to your long-term financial goals or whether it's a short-term comfort that quietly works against the financial future you're trying to build.
If this conversation helped clarify your thinking, we genuinely appreciate a like. Drop a comment telling us what your current car situation looks like. And if you haven't already, subscribing keeps these conversations coming.